Welcome to today's investment analysis of Intuitive Surgical, ticker ISRG. Our current stance is a hold with a 65% confidence level. ISRG is a world-class business with a fortress balance sheet, characterized by zero debt and an exceptional gross profit margin of over 66%. However, we are recommending a hold for the next 3 to 6 months primarily due to valuation. The stock trades at a demanding 60.66 times earnings, which prices in several years of future growth. While we expect strong 20% EPS growth, the current price limits significant short-term upside, and we anticipate the stock may trade sideways as it consolidates. To understand why ISRG is a market leader, we look at its razor and razor blade business model. The razor is the Da Vinci surgical system, a high-cost capital investment for hospitals. Once installed, it generates a steady stream of recurring revenue through blades, the proprietary instruments and services required for every procedure. This model drives elite-level profitability, with a net profit margin of 28.38%. From a financial health perspective, the company is incredibly liquid with a current ratio of 4.73. The primary concern for investors remains the high PE ratio and a forward PEG of 4.25, suggesting the stock isn't cheap relative to its near-term growth. Let's weigh the bull versus the bear case. The bulls highlight an unmatched competitive moat, high switching costs for hospitals, and a pristine balance sheet that allows for internal R&D funding regardless of interest rate hikes. On the other hand, the bears worry about extreme valuation risk. At a 60+ PE, any slowdown in procedure growth could trigger a sharp correction. We also see rising competition from giants like Medtronic and Johnson & Johnson. We believe the bulls win on quality, but the bears win on price right now. We are holding because while the long-term trajectory is compelling, the stock is currently priced for perfection. Looking at catalysts for the next 3 to 12 months, the most critical metric is quarterly procedure volume. We want to see growth accelerating above the 18 to 20% range. We are also watching for the adoption of new systems like the Da Vinci 5 and Ion for lung biopsies. Looking further out, international expansion in Asia and Europe remains a massive structural growth driver. However, we must remain vigilant regarding risks, specifically potential pricing pressure from new competitors and any freezes in hospital capital budgets that could slow down new system placements. To conclude, our monitoring checklist for ISRG focuses on 3 main pillars. Revenue growth must stay above 18% year-over-year, gross margins must remain stable at 66%, and system placements should continue to grow. Warning signs to watch for include any margin compression below 65% or a decline in procedure volumes. Conversely, beat and raise quarters and new regulatory approvals would be strong positive signals. ISRG remains a high-quality compounder for any portfolio, but we are looking for a more attractive entry point or a stronger catalyst to move from a hold to a buy.